Welcome to the Everest Insights, where we decode the intersection of capital, policy, and innovation for Asia's discerning investors. My name is Jeff Lee, CEO of Everest Strategic Asset Management. Today, we're diving into the extraordinary journey of Ram Parameswaran, a true Silicon Valley insider and one of the most thoughtful tech investors of our time. Ram began his career as an engineer at Qualcomm, transitioned into equity research at Sanford Bernstein, and then sharpened his edge at elite hedge funds like Qualcomm Edge and Altimeter. In 2020, he took a bold leap and launched Octahedron Capital, a high-conviction tech-focused fund now managing over $500 million across public and private market. What makes Ram's story especially compelling to our audience, many of whom are Chinese high-net-worth investors, is his unique ability to generate exceptional excess return by identifying the best company in the global innovation ecosystems. Based in Silicon Valley and deeply connected through his wife Annu Harisharan's growth fund Afra, Ram has access to the most promising startup and scale-up in AI, software, and semiconductors, sectors that are increasingly difficult for Chinese investors to access directly due to the geopolitical tension. We'll explore how Ram thinks about stock picking, portfolio construction, risk management, and the art of exiting positions. We'll also uncover how Octahedron creates powerful synergies between public and private investing, and how his partnership with ESAM opened new doors for Chinese investors seeking exposures to the future of global tech. We will break this episode into three parts. Part 1, from engineer to portfolio manager and founder of a hedge fund. Part 2, Ram's investment philosophy and tech trend. Part 3, risk management and building durable hedge fund firm. Let's get started. You started at Qualcomm as an engineer, then moved to Sanford Bernstein as a sell-side analyst. What did those early roles teach you about product intuition and analytical rigor? Transitioning from analyst to portfolio manager is a leap, from recommending ideas to owning outcomes. What mindset shifts were most challenging in that move? At Falcon Edge, a Tiger Cup fund, you were immersed in high-conviction investing. What raw lessons on team dynamics or market realities stuck with you?
So maybe you can
Jeff,
share a little bit about that.
Yeah, absolutely, Jeff. Thank you for having me at this podcast. It's fun to see you and catch up with you again. Thank you for coming for LP Day. Looks like you had a good time there as well.
Absolutely. Yep. I love it. Yep.
So the journey has been very interesting. And if I take a 10,000-foot view on this, it's actually not very different. Even though it looks like many stages in the journey, the concept is still very simple. I love technology. And I'm an engineer. I grew up in India, Southeast Asia, Africa. And in some ways, working and living in all these parts of the world really has impacted the way I think about technology. So that's number one. So very lucky to have that kind of background. So I grew up in rural Indonesia, Nigeria, Kenya, India, all before I was 21 years old. Then I came to America when I was 21 to get my master's in electrical engineering at Virginia Tech. And part of the reason I came to America was, at least back in the day, India had no opportunities. It was the it was the dot-com bust. And at least back in the day, India and America were very coupled economies from an equity perspective. So NASDAQ goes down, everything blows up in India as well. That has completely changed in the last 3 or 4 years, but that used to be the case back in the day. So I came to America to basically study, join big tech, have a nice house in Silicon Valley and retire, which is a dream, right? Unfortunately, what happened was...
What year was it at the time? Sorry.
This was 2001 when I first came.
Okay.
And Jeff, life was difficult, right? My first job in America was I washed dishes. I washed dishes in the college cafeteria for $6 an hour.
Wow.
My furniture was, what's that again?
Yeah, so that's your part-time, or is it initially when you come to United States, when you study in Virginia Tech, you also work in a different kind of part-time job?
Yeah, I come from a very middle-class background in India. So first of all, in India, there are capital controls. You can't take a lot of money out of India. So I understand the pain of capital controls acutely.
Yeah.
I can know the rupee to a dollar, it's so expensive, right? And America's an expensive country, even in 2001, if your parents made money in rupees. And so many of us came very middle class to America. And so typically you go and you find a research professor to do some work with or a teaching assistantship. But in 2001, because all of university funding had dried up, there were no jobs and there was no research financing. So you had to make ends meet. So my first job in America was actually washing dishes. And then I rolled burritos. And then I became a cashier for the first, let's say, 6 or 7 months of my life in America. And luckily, though, I was able to find a professor who, my wife and I have an endowed fellowship in his name right now. And he gave me my first chance to do research. And the trick is, once you become a research assistant, you become a university employee, so the tuition is free.
Yep.
And he pays you a small stipend. So life was good. I also met my wife there because I know you're going to bring up my wife's topic in this conversation. So I met her also in graduate school. She was also an engineer from India, and her first job was flipping burgers. So when you talk to her in a different podcast, it's a very similar story.
Wow.
Anyway, we met there in 2001, 2002. And then by 2003, things were getting better.
So that was, let me interrupt. So you did not go through the typical Indian kind of matching process for the marriage?
No, there was no matching. No, she was really beautiful, and I met her in grad school.
Interesting. I have so many Indian friends. And then remember at one point, he told me he went back home from US and then his mom kind of arranged him to meet with so many female for marriage. Yeah. So I thought that's a kind of...
one of them, Jeff, I think once you get to know me really well, you will learn that I never listened to anybody. So I never listened to my parents forever. It was never going to happen. Long story short is in 2003, there's only one company really hiring electrical engineers. And that was Qualcomm out in San Diego. Because Qualcomm, by the way, legendary engineering firm. And we had moving from simple phones where you just had voice calls to the first versions of data on cell phones. Now, this is even pre-iPhone, by the way. So this is 2003, 2004. And so I was the first class of engineers hired out of some of these elite electrical engineering institutions. So I studied information theory, digital signal processing, systems engineering. And so we went to Qualcomm and we were building 3G, first on a commercial basis on the chips in the lab. And my first 3 years, I mostly spent out in Europe, actually. So I worked in Helsinki, Turin, Madrid, Frankfurt, just all over Europe, commercializing 3G for Qualcomm for the first 3 years. And my wife, Annu, also did something very similar. It was the rocket ship engineering experience, Jeff. My team went from, I think, 30 or 40 people to almost 3,000 people in 3 years. So what I call insane explosive growth, even at Qualcomm back in the day. Because imagine first data on phones after the crash. So insane scale and growth, massive responsibility at a young age. I was only 25, already became a manager, was managing people, working with my senior bosses. But along the way, I started getting a little disillusioned because the work had gone from doing really fun, difficult engineering problems to doing a lot of coordination and managerial work. And I wasn't actually having a lot of fun. Meanwhile, what I really wanted to do is I had always learned about Silicon Valley. Remember, I was in San Diego, which is not Silicon Valley. And I wanted to find my way to Silicon Valley. But one of the ways to do it back in the day was to go to business school and then become a product manager. Now, the big company in that time, 2003, 4, 5, 6, was really Google. That was a company taking off. And they would not hire double E's back in the day. They would only hire computer science engineers. So you had to go to business school to go there to find a job. So I started talking to my wife about, listen, maybe you should go to business school and try to change careers completely. And so what happened then was my wife, who really is smarter than me, for our honeymoon, we went to New York City. And then we spent our entire honeymoon touring business schools, right from Boston and Harvard and MIT, down to Dartmouth, then to Columbia, then to Penn. And then we were really amazed that this entire universe existed outside of our little cocoon. First, remember, we went from India to Virginia Tech, which is a rural campus, and then to San Diego, which is paradise. And so we're like, wow, this entire thing exists outside of a small focus. And so we applied to business school and we had a challenge because she got in, I also got in, but we couldn't afford to go to business school together because business school is very expensive
Right.
and we are taking a lot of debt, right? We don't have a lot of savings at 26, 27. We have no savings. But we were very lucky. We had the courage to take the leap because even then, one of the concepts I've always loved is how do you think about asymmetry? So if you're sitting at 27, you have two nice cars in San Diego and you have a good job and you're doing well, I think a reasonable answer is to just continue that life, right? It's the American dream. I've always loved asymmetry. So the question was, if I fail, I can get my job back, I think. Maybe I won't be at the same level, maybe I get a lower level. But if I succeed, something big could happen. So I've always had this internal concept of asymmetry, which is, I think, has made me a good investor because it's very difficult for a middle-class person like me or my wife to do what we did. But I think one of the lucky, and I think it's luck, not skill. I think we've always had a feeling about asymmetry. What could go wrong and then what could go right? So always try. If it's too much risk, don't do it. So anyway, so my wife went to business school at Wharton, which is when I became an expat. In fact, those 2 years she was in business school, I took an expat role for Qualcomm and I lived in Latin America. That was the other big continent. So by the age I was 27, I'd worked in Europe, worked in Latin America, and lived all over Asia and Africa. So again, and I also lived in America. So the only country left for me was China at some point, which I'll come later.
Yeah.
Anyway, so she went to business school. I went to business school later at the University of Chicago. And initially when I went in, my plan was to go and become a product manager. Go back to Google, life is good. This is where I got very lucky. I ended up going to a business school, which is really the ground zero of finance and ground zero of economic theory and economic thinking. And I don't know if you know this for your Chinese audiences, but the University of Chicago is legendary for the concept of free markets capitalism.
Yeah.
And philosophically, the belief in freedom of individuals. So I go there, and again, instead of just struggling to find the banking job or the consulting job, which I still tried, I didn't get any job, by the way. I'll tell you that story too. I said, I'm going to study. I'm going to learn this entire new thing. So the other thing I think about that works for me is I actually love learning. I'm a bit of a nerd, both a history nerd, business nerd. And I've always loved reading stories about people. And even though I'm an engineer in real life and I code, I program, I build, in my hobbies, my life is ready to learn. And so I went to Chicago, and that's when I discovered finance for the first time. And so for my internship, I said, I'm going to go apply to all the big mutual funds. So I went and I applied to Fidelity and T. Rowe Price, et cetera, et cetera, et cetera. And you know what? I pitched Apple long and BlackBerry short.
Okay.
And
so you do have a pair trading concept at that time.
There was no concept. It was only instinct. I had no idea. Remember, I had no idea what investing was. Jeff, till 31, till 29, I'd never bought a stock in my life. Because middle-class Indian people, they only save and put money in a checking account.
In the bank.
Understand, my parents are very middle class. So there is no concept of investing and making money. So even in Qualcomm, again, remember, you don't make a lot of money as engineers. You make $80,000, $90,000. And after taxes and everything, you have not much money left. So what do? You use your options as your rolling cash account. You buy them at a 15% discount, sell it immediately, capture 15% plus whatever appreciation. That's what you do all the time. So at 29, but again, I love learning. So I said, this is so interesting. I think I'm one of the best. I'm very good at engineering, especially wireless engineering and communications. And I went to these interviews saying, I think I know about the industry. Now, I'm sure my pitch was bad. My accounting was terrible because no engineer knows accounting. Learning in business school what accounting is. I never used Excel in my life till that point in time. But I went in pitching Apple long and BlackBerry short. And Jeff, not surprisingly, I got thrown out of every interview. Not surprising. And I asked them, do you know, guys, why you want to buy Apple? The pitch was wrong. Apple trades at 50, 60, 70 times earnings. BlackBerry is 6 times free cash flow, 7 times free cash flow. But I said, there is going to be no free cash flow. And they said, what do you mean? We love our BlackBerries. We're all going to be using BlackBerries when they have the new version. I said, what do you love your BlackBerry for? And they said, we love the keyboard. But I said, guys, the world is a capacitive touch resistor for your screen. You're not going to have a keyboard. And by the way, are your kids buying BlackBerry phones? Are they buying Apple? Oh, they're all buying Apple. So I said, why do you want to own BlackBerry? The other thing that they did not know that I knew was because Qualcomm builds the monopoly baseband chip on all phones around the world.
Yeah.
By this time, I became a senior engineer and I was commercializing chips. We were not sending our teams to Canada. Everyone was going to Cupertino. And by the way, Apple had poached me from Qualcomm. I did not go to Apple in 2009. I went to business school instead. But in a different world, I would have just gone to Apple and worked there. But I did not go there. So the first insight I had, Jeff, was even when I was 29, 30 in these interview processes, that my goodness, I think people, especially East Coast of America, they do not understand technology. And there is an arbitrage. So for me, the insight, remember in Chicago, you learn about arbitrages, economic theory, freedom.
Yep.
If there's an arbitrage, exploit the arbitrage. So I said, while I was sitting here in these interviews, and these people do not understand technology, so let me arbitrage that. Let me become a good technology analyst because I don't think people understand this. Jeff, funny enough, that was in 2010. This is 2025. 15 years later, Jeff, the arbitrage is as wide as ever and getting wider. It is crazy. And then Mark Andreessen coined that many years later. He called it the New York Palo Alto arbitrage. He called it that. These guys don't understand technology. And I still believe to this day, I think technology is so fast moving. It is so complicated. It is so nuanced. I actually believe that you have to be immersed in it to understand it in a way that can actually make money, because technology investing is actually really hard. It seems easy in bubbles, but when the bubbles burst and things implode, man, there's a lot of disruptions. You have to be very careful investing in technology. And so anyway, the long story short is I saw the arbitrage. And so I said, okay, if that's the arbitrage, what do we know about finance? We exploit the arbitrage. So then I decided to basically become a good technology analyst versus trying to do different things. And that was my first job in finance. In the summer of 2010, I was lucky enough to intern at Sanford Bernstein, which was a legendary research firm. And I was the top ranked analyst in that class. And they gave me a chance to pick my analyst to join full time. And so this is where another lucky thing happened. So now I graduated 2011, business school. Guess what was happening in 2011? The mobile internet, where I was struggling 5 years before to put a small connection through a system. Well, Steve Jobs had built the iPhone, the iPod first, then the iPod with the screen. And then remember the famous talk in 2007 where he said, and one last thing, here's the iPhone with a very thin data connection into the system. But what happened in 2007 and 8 is everyone started building on the App Store. And by 2011, when I graduated, the fastest growing internet company after many years happened to be Groupon. And Groupon was a Chicago company. And in my second year, the CEO of Groupon taught me a class called Building Internet Companies. So again, this is luck or is this timing? Is a skill? I don't know. I think I got a little lucky. But I saw that, I said, okay, wow, we've gone from simple phones to simple data on phones. The early version of data on phones actually failed because the only thing you could do is download a ringtone, play some games. It's useless. If you remember back in 2006 and 7, then the iPhone came, changed everything completely. And then we ended up in this world where we could get the App Store and then complete companies could be built on the back of the App Store. So I said when I joined Bernstein, because I had a choice to pick, I said, I want to build global internet. Because I thought the first version of internet was Yahoo and Google and stuff, and even Netflix had just made Netflix was just thinking of making the transition to streaming. And I remember the day when they announced the deal and it was down like crazy amount. But my point is, so lucky in 2011, I started researching Meta, Google, Amazon, Yahoo, eBay, and Netflix. So again, I was able to catch the first wave was just data on cell phones. The second wave was the entire App Store. And so we were able to capture that. And then I was very also lucky. My old boss The other thing I've been very lucky about is I've had some very good mentors and very good teachers. So I think in life, nobody is born that smart. I think you have to put yourself in places where the greatest people in the world teach you what to do. And my personal belief is always find those great teachers. And so the quick TLDR for Octahedron is people say, do you want to be Co2? Do you want to be this? I said, no. From Philippe Lafont, I've learned this and this. From my old bosses, I've learned this, this, and this. What can I learn and what should I discard? And then that is Octahedron. Okay, that's a good segue into the firm.
That's a really amazing journey. You often mention luck. And sure, maybe luck played a part, but I think it's far from the whole story. There's clearly a lot more going on. Your ability to spot trends early, your discipline, and the way you've consistently positioned yourself to capture asymmetric advantages. That's not just luck. That's intentional. I feel like you've always had a sharp eye for identifying the big shifts, whether it's in your own career or in the markets. You've moved across industries, geographies, and roles, and each time you've managed to find the signal in the noise. That's rare. You've picked the right sectors, the right regions, and the right timing. And that pattern shows up both in your investments and in your personal journey. And maybe that's partly because of your background. You've lived and worked across multiple continents before you were even 30, and that global perspective really comes through. Plus, you started as an engineer, then moved into finance, so you bring both technical depth and market intuition. That's fascinating, and I'd love to dig deeper into that when we get into your investment philosophy, especially how you think about sizing, conviction, and going long or short. You've worked at some of the most respected firms and funds, and then in 2020, you made the leap to launch Octahedron. That's a big move. You were doing well professionally, financially, even personally. So what was the trigger? Was it about building something more founder-aligned, more nimble? Was it about having the freedom to apply your own framework and make decisions with full clarity? I'd love to hear what really drove that decision. What made you say, now's the time to build my own thing?
That's such a good question, Jeff. So I think I'm going to start with a point of vulnerability. See, the reality is, when I was growing up, my dad worked in textiles. Now, textiles is a very difficult industry. It's very cyclical. And the reason we lived in many countries in the world is not because my dad was a big shot. It's because the industry was so cyclical and so vicious that the factories closed down. So I think from a very young age, there's a piece of research. And if you read the story of most great entrepreneurs, there's a famous line that says, the story of a son is written in the story of a father. The challenges your father goes through, typically father goes through, and the issues they have usually creates a long-lasting impression in some person's head. So for me, when I saw my dad being a very talented engineer, but always constantly cyclical because of the industry, I always felt like I don't want to subject my family to that cyclicality. I've got to be my own boss. So even when I was 19, 17, 18, I said, man, at some point I want to build a company. I want to be my own boss. And this, by the way, married when I went to Chicago, this concept of freedom. So I've always thought about freedom and independence is just part of my personality. So even though I did not know what to do, how to do, where to do it, I always had a belief that if I knew enough about something and if I believed in it hard enough, the universe will conspire to give it to me. So I always had that belief. So I always wanted to start a firm. In fact, when I joined Rick Gerson, part of the reason I wanted to leave him to join Brad was Brad had started the firm at Altimeter, but very little capital. So I wanted to see, what does it feel like? Because in Falcon Edge, we had all the resources, like everything you want. It's a big tiger firm, big $3-4 billion launch. Very easy to get resources and do it. But I said, what if I don't have those resources? How can I perform at a very high level without resources? And so for me, it was a practice in trying to be resource constrained and still being excellent. So that was the reason I left for Altimeter as well, because it's a smaller, younger firm. What happened though is, so one, I wanted my personal independence and freedom. Two, by that time, I had my own confidence that I'm pretty good at this idea of internet and payments investing. I'm pretty good at it. I've done publics and privates. I have a lot of confidence in my abilities to pick companies, both long and short. So now why wait? Because I turned 40 and I started my career so late in finance. So I'm a grandfather in many ways when it comes to finance. I started only when I was 31. See, most people had a 10-year head start on me. But as an immigrant to this country with no money, no resources, engineer, I had to accelerate. I had to at least try to keep catching up, right? And so I said, listen, I think I'm very good at this. I'm pretty confident the world is going to be constantly digitized. I'm pretty sure that I know how to make money under very resource constrained situations. And by the way, if I do it right now, by the way, also this goes back to having great bosses. And my old boss basically said that, listen, if you fail, just come back. He gave me an offer to come back. So I said, goes back to asymmetric. What if it goes right? And because I'm pretty well known in the industry, I'm reasonably confident that if everything fails, great PMs will hire me to be a PM. Like I know this already. Like I get a job because I'm a money maker.
So it's a good option strategy. So you have a downside
It's a really a good option strategy. It's like literally an out of the call money option where you're paying a very low premium, right, to buy the option. So those are the few concepts, right? And so that was the reason. Now, there's a more philosophical reason to start the firm because there are so many hedge funds. Why would we also succeed? Now, by this time, the reality is I had looked around the industry. Remember, all this while, for 15 years or 20 years, I've been reading business history. So I'm a student of business history. The story of Amazon, the story of Nike, the story of Costco, the story of Walmart, the story of McDonald's, right? These are great companies. And in fact, if you've come to my office in California, you'll just see it's all business history books, generally on our walls, right? And esoteric ones. In fact, the first book I ever read when I was 16 or 15 was Akio Morita and Sony. I fell in love with that book, which is a very interesting thing for a teenager to read in my teens, right? So I used to love that even then. Every business, Jeff, in my opinion, in my 20 years of learning this, can be decomposed into three simple things. You build something that people want. Number two, you hire incredible employees, make sure that they get a chance to do their life's work. And number three, you obsess about your customers.
That's right. So let me interrupt this a little bit. So that's very important point. So when you mention about these three important factors, they all need resources, right? So when you work for the big firm, and then naturally they can easily provide this kind of resources for you, and you can hire the best talent. For the startup, how did you really overcome this hurdle?
Yeah, we had, I think, $12 million when we started. That was very small. So Jeff, so the first thing is, remember, every entrepreneur is irrational. Starting a firm is an irrational decision because the odds of failure are against you. There's a high chance you're going to fail. So every entrepreneur that I've met in my life has what I call irrational optimism, that it'll work out. So step one, I had irrational optimism. Second, the beauty in our business is that you need very little capital to start. The capitalization, I capitalized the firm with a couple of $100,000 to pay the base bills before I started the firm. So let me give you an example of how frugal we were. And number two is everything is IP. It's in your brain. And that's why the business is so profitable, where if you scale, your brain can be used for infinite returns on incremental capital. There's literally infinite returns on incremental capital. So the nice part about starting an investment firm is not that complicated if you realize that your input capital is your brain. Everything else is output. The mistake everyone makes is that they spend too much time and effort marketing. So they go out, they try to raise a lot of money, they have a very swanky office, they hire assistants and IR and operations team, and they just market without realizing the main thing is performance. So you got to invert the equation, number one. So what did we do when we started? So let's go back to the framework into we need a product people want. In my case, that was my brain, my historical performance, and my old bosses gave me my historical performance. So I had something to show. Number two, hiring employees. That is expensive. But remember, when I started the firm, I focused on my circle of competence, which is internet and payments. So I didn't need employees. As we raise capital, we could hire people. And number three, obsession about your customers. That is my job. My job is to be obsessed about my LPs. And in fact, I've taken it one step further. I think of my companies as well as my customers. I really take care of them. And that's why so many CEOs came and talked to our LP day. So my point really is those three frameworks, which is how product people want, obsess about your customers, and hire great employees, actually can be done in this business more than anything else if you're willing to invert what everyone else does. Everyone starts with they want lots of money, they want a nice office, they want travel budgets, they want to fly all over the world. I did nothing of that. What I started with is my capital, my old boss's capital, and then a few friends who said, I'm going to support you into business. Now, luckily for us, those few friends are the who's who in Silicon Valley.
Yes, I saw that. You must have something special to attract those people, those LPs in the Silicon Valley.
We'll talk about that too. But anyway, so you see my point. The point is those three things can be done with very little capital, but you have to be very good at your craft. So Jeff, many people come to me and say, Ram, I want to start a firm. Oh, but I need money for that. I said, no, you don't need money for that. What you need is an infinite confidence that you're a moneymaker. So are you a moneymaker? If you have that confidence, I believe you can start an investment firm because you put up performance, you scale slowly, it's your IP. And then that's how we build the firm. So today we run well north of $500 million, but it took us 5 years to get there. And I did it the difficult way, and I did it the way that is very sustainable and durable because I run the firm like I want to see my companies being run. Durability at scale for many years. And so I actually believe, Jeff, that's the reason I started the firm, because if you take that framework, I realized that most investment firms do not have it. So I was working in two firms that I think were very good from a culture perspective, and they paid us quite well, in my opinion. But if you talk to my peers who wanted to start a firm, they would tell you, oh, I'm leaving my firm because I didn't get paid enough. That is the wrong reason to start an investment firm. The reason to start an investment firm is you have an insider of the world and you want to make an excellent, legendary investment firm over time. That is why I started Octahedron, not to be a boss. Yes, I wanted the freedom, but I believed that two things. My competition was actually very weak. They did not focus on their customers. They did not have a great product, and they did not have great employees who loved them. Meanwhile, something even better was happening. As in your world, a lot of the incredible money in hedge funds has gone to the pods, right? Millennium, Citadel, SAC. Now, what is happening in those pods, when I was interviewing lots of young people, they're very smart and intelligent, but they are not investors. They are traders. And the rise of these pods has created more volatility, at least in the US. So if you are a person with patient duration and with patient capital, you can exploit that arbitrage. But it gets even better. I can't even hire these analysts. So they're destroying an entire generation of young analysts because they're all trading all the time. It's very hard to make money in the long term by trading. It works for Ken Griffin. Does it really work for the PM or for the analyst? I don't think so. So it's so interesting. We are at this point of time where I actually believe that many single managers, they're struggling because they can't attract more capital because they've built the firm in the wrong way, in my humble opinion. Meanwhile, the entire industry, all the volumes are being sucked up by the big platforms. And understandably, because many of us have underperformed. But what if you build something that performs well, then it's going to be very distinctive. So that is what Octahedron is. Very distinctive, high performance, focused on a few things, small team, and obsessed about customers, obsessed about my team's performance, and a product that hopefully everyone wants.
So will you stay that way in a relatively limbo size? What is your optimum AUM if your style is to focus on the long term and discretionary high conviction, not a lot of trading, so that you can really achieve your long-term return?
Yeah, so Jeff, as there is only one, there's a rule of physics in finance, which is size becomes the enemy of returns.
Yeah.
So the first answer, Jeff, is I don't know the answer because I cannot tell you today. I cannot tell you today at what time my high performance will slow down. What I do know is in a previous firm, we could scale the business to 3 billion, and up to 3 billion, there was no performance degradation. So that's number one. So we are 500 million plus now. where you're going to find the right partners. As we haven't raised external money in 3 years, we're opening this podcast because we want to attract a few partners who can be great partners for the long term. But ignore that for a second. So data point number one, till 3 billion, I didn't say the degradation at my previous firm. But data point number two. So typically, and I want to also correct you on one thing. I want to make sure I clarify something about the trading part. But the data point number two is every portfolio is a sum of underlying assets. Typically in our long short fund, we typically have 10 to 15 long ideas, round numbers, 8 to 15 is the right number, but let's say 10 to 12 in the median. And then we have long tail of shorts. The shorts are sized very small, so there is no, I can even short a mid cap and small cap, and it's not going to be a problem. On the long side, I look for a company that trades at least $200 to $300 million per day. Now, if I have a $200 million stock volume per day, and I want to get out of the stock in 3 days, I can put a $200 million position on the name. Now, if I have 15 stocks and the smallest position is a 5% position, then I can have 20 stocks of the same size. So 200 multiplied by 20 is a $4 billion stock. You see the math? So my fund can actually scale because, and by the way, my biggest company trades $4 billion per day. So there is no limits to it. It's not that the strategy will fail because we're buying the highest quality public and private assets in the world. And many of them tend to be scaled players. So if you look at our portfolio, we don't have any small caps, nothing less than $1 billion. In fact, a company today I was looking at, it's $1 billion in market cap, but it trades $7 million per day. And we won't even touch it. Like, I can't do anything with it. So I'm looking for liquid stock because, again, our LPs look at us for liquidity and exposure to the great tech trends of our life. So in many ways, Jeff, we're actually a replacement, in my opinion, for the venture capital portfolio. Because I'm going to make an argument to you that public stocks in tech are better uses of cash. And if you look at our historical IRR, the returns are like top decile VCs, but with liquidity. So I care a lot about liquidity, Jeff. Because my wife also has a venture fund in our own family. She has an illiquid portfolio. We want a liquid portfolio.
Right.
So you see, even selfishly, I love liquidity. And what we've only done is I think we found a machine that generates high rates of return. I don't think there are limits to it, but the only way we will know is we go up that path and see if it's like walking up a hill. We do not know where we're going to get tired. It should be at the summit, in the middle.
Right.
But we can walk up, we have the equipment.
So in that case, because you mentioned about liquidity, you also mentioned about your kind of focus on the longer term investment return. How do you optimize this too? The liquidity, what I mean is really the fund level liquidity, not just the stock level liquidity. So because we also talk to the other the other is lonely fund manager, they really want their investor to be really long term, right? So almost hopefully no redemption kind of type, so that they can really align their investment goal with the fund's strategy. So how do you balance this two? How do you really optimize? You allow people to redeem in either quarterly or basis, and then at the same time, you also want to deliver a good IRR for them.
It's a great question, Jeff. So step number one is I want to correct you on this long-term thinking. The reality is, from a practical perspective, in the long term, we're all dead. First of all, I want to correct you on one thing. I think being long-term is important, but the way I define long-term, in my view, because tech is such a unique beast, it's so volatile.
Yep.
I would argue that after all my experience, I can only look out 3 years. I cannot look out beyond that. It's too hard. Because things change so quickly. The CEO will do something silly. Can you have imagined that in 2022, Mark Zuckerberg would spend all this money on the Meta Labs? No, there is no way of knowing it. Can you have written a DCF in 2005 that Microsoft will build Azure and that Azure will be the biggest driver of value creation of Microsoft? It is impossible to know these things. So first of all, when you say long-term, I'm looking at rolling 3-year cycles. To be clear, we are not venture capitalists. We are stone cold killers. We need to make money. Okay. Number one, to do that, you have to telescope between the long term and the short term. We never run 5-year models, 7-year models. In fact, I think it's a fool's errand to do it. We look for current quarter, current year, next year after. So today in 2025, we are rolling all our models to 2028, but really we are valuing our companies on 2027 because that's where we have highest confidence. Okay. So that's the first step. Now, then we come to risk management. This comes down to the liquidity question. If a stock is already reflecting its 3 or 2 years forward price, Jeff, we are taking risk off the table. We're selling the stock. So what does that do for you? In our long only fund, we've got rules on maximum exposure. And our LPs have agreed to allow us to keep up to 20% cash, which means that in times of extreme froth, or I'm a little worried, I don't see much asymmetry, I can keep cash. And our LPs are okay with it because our performance, even after keeping cash at times, is very high rates of return. So even though the cash is not a drag on performance, but the performance could be higher had we deployed it, of course. But I think the optionality to have cash is a very valuable one. And we agree to our LPs, that's what we do. In the long short fund, it doesn't matter. The net and gross can move as it is. That's number one. So we take risk off when we think there is. In fact, I would argue that if you plot our performance during times of very high momentum, we underperform. So don't expect us to chase trends and chase the market. I get calls every day saying, Ram, get me into OpenAI, get me into Anthropic. We don't do it unless you put up personal money. I am not chasing a trend. I would rather buy Databricks when it's out of favor in 2020, which is what we did. That's our biggest position now. So similarly, I remember I was buying Google at 100 when everyone said Google is there. I said, no, it's actually going to turn around. And guess what? Now Google's the most loved stock in the next cent. My point here is the way you make the returns we do is you have to have a little bit of a contrarian bend. Now also momentum has to work in your favor, obviously, right? Else you'll end up in a value trap. So there's an art to doing that. It's a real difficult art in doing that. However, my point to you on your liquidity is we keep a lot of cash. But the second thing we have done well, I think, is we are very discerning on the LPs we bring on. So as Jeff, we have met at this point 4 or 5 times. And now we have the comfort level to have a deep conversation. But we do this with almost every LP, not just me. So I have a really good chief operating officer who you have met, he does the first 3 meetings. And then I do a couple of meetings too. Because, Jeff, unlike most firms, I am building a partnership and a community. We care about you, and therefore you should care about us. We will undoubtedly go through difficult times. There is no way you can be successful without getting through difficult times. But at a time, you have to have incredible LPs who will stick with you. Of course, there will be some redemptions. Of course, there will be. But as long as there's no run for the door, you're generally okay. So I think we've been lucky in the sense that while we have had redemptions even in our 5 years, it's generally been more positive than negative. And so I think the organization design, the way you bring on world-class LPs is almost as important as your gate. So let's talk about the gates. And that's why, Jeff, we're going to work together because we as Octahedron made a decision that you are a world-class person.
Thank you so much. I think that's also something I would like to ask you about. What sort of investors are your favorite? You mentioned about us. We met only a few times, but I feel that your investment philosophy is really aligned with mine. I hope that my clients are also aligned with that as well. We do see each other a good fit. That's why we really want to work together.
So